interesting thing is that some of the panelists I have known for more than decades. Can you guess who it might be? You'll see by the level of irreverence, probably. But nonetheless, it's delightful to have you all here. So there are so many questions that we have to address when we're thinking about risks. I almost don't know where to start. Maybe I'll start with something kind of simple, which is crypto risk itself in an ICO. When an ICO, we heard earlier today of an ICO that successfully raised a number of million in Ether. And then the price died, so now they don't have enough money to actually execute the project. Let's start with that. Does anyone want to pick up that risk and how to address that? Because maybe that's a simple solution.
Sure, I'll start. I think the question of treasury management for projects is one that's really become a major kind of question in the past year just because of the volatility in the crypto market. So my recommendation for projects is generally that they map out what their operating expenses are going to be for a period of maybe 12 or 24 months, and then maintain some exposure, maybe that's 10 or 20% in Ether or Bitcoin or whatever they raise, but make sure that they do have kind of a more stable capital base, because otherwise, they might end up not able to actually build the project for which they raised capital to begin with.
And I have to apologize because I must be getting near the end of the day and I probably need a drink because I forgot to ask everyone to introduce themselves. You are obviously Arianna Simpson, and you do speak with great authority on this because not only have you been an investor in the space for some time, but you also worked at BitGo, who were all about managing custody risk as well. So I'm going to come back and ask that. But what are you doing at the moment, Arianna?
So I run a fund called Autonomous Partners, which I launched in 2017. I invest largely in infrastructure and monetary use cases, both in coins and tokens and in equity.
Fantastic. I love the fact you are investing in tokens as well. And I guess you know how to look after them. And so,
well, I would hope.
Perhaps you might share with the audience of investors who are thinking of buying tokens, how do you look after tokens once you've bought them?
Well, I think obviously the issue of custody is one that's very much part of the conversation these days. I think this is kind of the first year in which real institutional grade custody solutions are starting to come to market. Unfortunately, right now there's a number of assets that, even in the top 20, which you really kind of have to self-custody. So I think obviously air gap machines and backups and vaults are still kind of part of the day-to-day operations of many funds. But there's BitGo, there's Coinbase, there's a number of other folks who have launched institutional custody products, and so I think a lot of investors are moving more towards that.
Have you seen any truly distributed solutions or decentralized vaults?
Not ones that I would trust.
Oh, that's so interesting. We've got to come back to you. Actually, that's a challenge for your fund. If I find one, I'll introduce it.
Terrific.
Okay, so David, there's a different level of risk that you address. Do you want to introduce yourself and tell us a bit about what you do?
Sure. So I've been kind of around the space for a while now. I started off my career at UBS and Millennium, more coming from the traditional trading and hedge fund side. Sort of was fascinated and enamored by Bitcoin and cryptocurrency back in 2012, 2013. I left Millennium, set up a company called SolidX Partners, and that was kind of my first entrepreneurial endeavor, and then had been investing in and around the space. And last year I partnered with Mike Novogratz to launch Galaxy Digital with the idea of being kind of a financial services and asset management firm focused on entirely on blockchain investing and cryptocurrency. And so I've kind of been approaching the space with the mindset of there are a lot of tools and traditional institutional kind of investment frameworks that have been missing and lacking in the space. And so try to help create some of those and kind of introduce risk management, introduce diversification. And I think, I've been pleasantly surprised that there are a lot of developments in the space and around some of the exchanges, around custody.
That's terrific. So you're deep into trading, you understand it. It means you work with exchanges a lot, you mentioned that. Why is it that we still hear almost weekly of exchanges losing the private keys of their clients?
Well, I'm not as concerned about that because that's something where those are centralization, right? This whole phenomenon, and we were having a nice chat beforehand. I like to think of this as like one of the greatest technological experiments of all time, right? An experiment where we're going from, a friend of mine, David Johnston, coined the term Johnston's Law, which is everything that can be decentralized will be decentralized.
Yes.
I came up with an iteration on it, Namdar's Law, where it's everything that should be decentralized will be decentralized. And I think that's what we're seeing. We're seeing kind of passionate entrepreneurs attacking every single industry and everything that we've seen so far in the earliest generation of the internet, and trying to see if a decentralized system and company and ecosystem and platform could be better, right? And so around a lot of the exchanges, in a perfect world, later down the line, we won't rely on a number of centralized exchanges to do all of our trading activity, right? And I think we're a little bit of ways away before any of these decentralized platforms and exchanges really take hold for exchanging value, but we shouldn't have to rely on a website to where you're going to store your digital assets.
It's funny now you say it does seem strange. I might not do that anymore, actually. I must try and seek alternatives. Okay, well, that's interesting. So, Mark, we had a fantastic conversation today. By the way, if anybody wants any problem solved, I was astonished because Mark seems capable of solving almost any problem you throw at him, which I love, by the way.
True.
Oh, by the way, and he's very confident about it. So, let's see. Risk. Discuss.
Well, let's see. So if I introduce myself. Hello, everybody. My name is Mark Turell. I do stuff. But I started off as a technology entrepreneur. I did my PhD work while I was working at Intel around collective intelligence and crowdsourcing. I was analyzing server log data, so I don't trust what people say. I like data to see how people actually did things. The company I created when I was 24, I listed as in the London Stock Exchange AIM market back in 2006. And as that was the first time I'd taken outside money, I had a direct experience of taking a company public. I was the last UK tech company to go public for about 2 years after that. But that meant that I went to every single lawyer's meeting and everything else, and I'm an entrepreneur, not a manager and anything else. So I left that company in 2010. We can have a discussion on board issues and everything else. Actually, running companies is another issue. The crypto stuff almost sort of got on my radar when my entrepreneurial friends that I really trusted that had gone the classic route of VC raising began to say, we're about to do a 30 million token raise. That was Civic, Vinnie Langham. And I thought, well, okay, even if this was not on my radar properly, I have to stick it on my radar now, given that there are some very serious people about to do and then executed some very serious things. I need to take another look at it. So I began to look at it at funding some of my projects, and I realized that as soon as I looked in, there are monsters everywhere. And having written a prospectus beforehand, now a prospectus has numbers in, and numbers don't mean number of transactions on the blockchain per second or percentage token distribution. It's a business plan. And I began to look at these white papers and realizing that they were just total and utter crap. Total crap. So I then thought, well, okay, the best way that I can learn more about this stuff is to be a paid advisor, because then you can at least be paid to learn on the job. It's a very entrepreneurial approach. And I began to look at all kinds of different companies, different projects, and everything else. Clearly at that time, but what was super interesting, and I created a paper fund with a friend because we were trying to work out, could we do something? And it was fascinating taking an angel approach or an early stage investor approach. And I really struggled because if you're early stage investing, you care about the founding team because you might pivot, are they strong enough? The market, the product, technology base. And you spend 98% of your time focused on that. I really tried to spend 50% of my time on the company when I was looking at these potential white papers, investment stuff. And in the end, I realized, best case, 5%. And actually, the key thing was, how fast can you flip it? But that was a really interesting realization for me because I think this is where the whole VC world is going to have some serious problems. And I became super interested as an entrepreneur about liquidity. Because when you see that an angel investment typically has a 10-year time to exit if it's successful and a 95% plus fail rate, okay, you're not liquid at all. I mean, it's basically charity. And even on the VC side, you look at only a 40% success rate and a 7-year exit time. I realized that a lot of the ways that people do classic investing, sensible or not sensible, we can debate that, is all going to change because it has to. But now, that wasn't to say we had to adopt this Wild Wild West type of approach, but we needed to work out, like, how are we going to go street legal and find a balance?
Well, As you can see, Mark loves the numbers. You're also quite good at predicting things. I'm going to come back and ask you for a couple of predictions that I know you've mentioned. So make sure I do before we finish. So Andrew, tell us about what you do. Tell us where you work, what you do, and why you're interested in the crypto space.
Sure. So my name is Andrew Romans. Probably my biggest bragging rights is that I've known this guy for, 18 years or 17 years, something like that. But I'm an entrepreneur. I founded a number of companies, raised over $150 million of venture capital funding, had an IPO, an M&A, and some failures. I then started Rubicon Venture Capital, which is a VC fund. I run the San Francisco office, and we've got a New York office. We've got guys in London as well, and we're a classic venture capital firm. When I got kind of bitten by the Bitcoin blockchain bug, I couldn't convince my co-founder to invest into blockchain token projects. And I decided to start another venture capital fund with the support of Rubicon with my partner in our LPs called 7BC. So it's a venture capital fund that is 100% blockchain focused. So there's two VC funds. And I don't want to take up much more time than that. I'll just say that we're interested in investing in blockchain companies. But we also have Rubicon, which invests in kind of broad tech deals.
I mean, we know the secret's out. We know you know about team risk. In building startups, we know you know about. You were supervised by FINRA, so you know about regulatory risk, etc. Yeah. Now, all of that is going to inform your decision on how to mitigate risk in 7BC. 7BC is going to either be one of the most successful venture funds going, or it will not have been able to figure out the risk. What are you doing around some of these issues, especially if you're investing in tokens? I mean, do you plan to invest in tokens?
Yeah, we are.
Wow.
And I'll say this too. I mean, I'm happy you brought that up about the FINRA thing. So I ran the Founders Club, which Eric knows about, which was an equity exchange fund. And before there was really a secondary market, when it was taboo for founders to sell before the definitive liquidity event of the company, we were allowing founders to swap equities. So we had these pools. It was like a fight club of entrepreneurs, and these guys are the original LPs of Rubicon. So it was kind of like we have this awesome, mafia that supports the startups. But I then started brokering the sale of Spotify and Joe Lonsdale selling Palantir, and then lawyers said Andrew, this is like a regulated activity. You got to get under broker-dealer. Yeah. So I got under FINRA, and so I actually have a keen understanding of the SEC and FINRA. And when I saw the whole crypto world emerge, I was like, man, you guys are breaking the law like crazy, and you're all going to go to prison. And so I think it's interesting to have that very legal FCA in the UK and SEC perspective of how to comply. It is possible to comply with existing laws. Don't beg for new laws to be written, but you can do token offerings and comply with each jurisdiction. So.
Okay, so let's try this then. So Arianna, let's say you see an awesome company in a regulatory jurisdiction where it is not yet clear, but you implement best practice. Do you think then that you share any of the responsibility with the entrepreneur if retrospective legislation comes in that says that was illegal?
Well, I think in many cases, regulation can change. So, ultimately, obviously, companies like Uber outside of crypto have certainly taken a direct approach and in many cases ended up winning. So I don't think these things are necessarily set in stone. At the end of the day, I try to advise companies on, some of these risks and direct them to people who know more about these issues than I do. But at the end of the day, it is the entrepreneur's ultimate decision and responsibility. And so I respect their kind of right to make decisions for the company. I do think that, we're starting to see a lot more sort of regulatory arbitrage. So some of my portfolio companies are choosing to be based out of Malta or at least partially out of Malta and other jurisdictions that are a little bit more clearly friendly. There are ways to do compliant offerings, obviously, in the US as well, but the burdens around, Reg D, Reg S, and Reg A plus compliance are non-trivial. And so I think a lot of companies are choosing to go to areas in which it's more clear that what they're doing is okay.
David, are there any frameworks that an investing or trading community, but let's say an investing community, can follow to help guide them as they evaluate investment opportunities?
Sure. So yeah, I think in terms of risk, right, as the theme of this panel and conversation, right, there's very different risks, and it's important for investors, for entrepreneurs to get comfortable with risks, right? So I think what's interesting about the current environment today is that there are newer risks than any of us have dealt with before, right? And so, as entrepreneurs that are dealing in the space, whether we're advising them or investing in the companies, right? Entrepreneurs have to deal with liquidity and liquidity treasury management for the first time. That's something they didn't have to deal with. They have to deal with understanding regulatory risks in different jurisdictions, whether they, on initially how they raise capital, how they distribute it, whether they airdrop tokens. All of these are new things that no entrepreneurs had to deal with prior to this whole phenomenon. On the investor side, right, having to deal with who and how is the risk shared if you choose to invest in tokens, something that could be regulated, could be unregulated, depending upon which jurisdiction you're doing it from. Are you then taking an unknown risk that later on down the line you're going to potentially get in trouble for investing in those tokens? And then around your own liquidity. I think what's fascinating is that you have a lot of people who come from a VC background that all of a sudden have to understand liquidity and trading more than ever before and what the risks are, and how that changes the whole model. We were discussing this earlier, and as a hedge fund and public markets investor, you really need to understand how these, like investing in early stage projects and what it means, what the risk is of giving an early stage project 3 years or a lifetime of funding, right? And what happens if they don't deliver on the technology? And so then when it comes to managing those risks, I think there really aren't that many tools. So you have a couple of choices. You have kind of to get as up to speed as possible and manage risk when you're deploying the capital, right? Really make sure, the same way that investors have for a long time, make sure you're dealing with the best possible teams, make sure you're dealing with proven operators, people who actually, have laid out some framework of governance, even if there's not governance built into it, at least have shown some transparency and governance about how they plan to use the capital. And then once the capital is deployed, utilizing things like futures, actually borrowing and shorting certain things to hedge different exposures that you have.
I think as one of our speakers yesterday, Simone, said that risk begets value. So we mustn't forget that the other side of this, which a lot of you are engaged in, is calibrating that so that you are better at evaluating the risk. I mean, this is a natural for you, Mark, right? Isn't this everything that you do and care about, is evaluate risk? Probably better than most of us, just because of the way you look at the world.
Well, risk should be managed. It shouldn't be avoided. But then you've got to price the return properly.
Yes.
So if you look at, let's say, if you're investing in crypto stuff, you kind of do need to look for your 5x. Because if you're only going to get 8% return, but you have a risk that the underlying asset that you have of your ether is going to drop by 90% or go up by this, it's a very, very, very weird place. But if I look, one of the things that I liked about this whole crypto space is almost like business artistry. And I've been looking at, how can investors be a lot more demanding of the companies? Because at the moment right now, it's a very strange place. It's almost the first time in, let's say, this entrepreneurial ecosystem where the companies are in charge. That wasn't the case for ever before.
No.
You certainly wouldn't normally give a 27-year-old kid $50 million to say, okay, here's money for the next 4 years. You just wouldn't do that.
Yep. Lambo.
It happened to me.
Yeah, I know. Well,
No, it's 26.
It mostly worked, but so what I become interested in is can we actually design instruments, protocols that investors can be more demanding of the companies that they're funding? And this also allows conferences like this to build coalitions of investors to be more demanding of the companies.
Well, I think that's also up to the investors. I mean, honestly, I see very smart investors doing things that make zero sense, like investing in valuations that make no prices, and so prices that make no sense. And yeah, the 5x or 10x just is not possible. And so I think it's also up to investors to be a little bit disciplined and say, well, let's not invest from a place of FOMO, but let's actually think about, what is the upside case here?
Name names. Tell us who. Just between us.
Never.
But part of the interesting thing with this is that if you look at your classic ICO fundraise, let's call it 95% of the money comes from funds, crypto funds. It's not, even if you pretend to go out to the public, bottom line is it's from a small number of investors and some whales. So then we look at, where does the money come from? Well, I mean, you might have certain restrictions about where you raise the money, but right now we're ending up in a global market world immediately. I mean, right now, before the Silicon Valley was pretty much, you throw a stone out of Palo Alto and you can hit your investors. Now, don't, obviously, even if you want to, even if you want to. But so right now then, but now instead you may have a third of your money's come from China, 20% has come from Korea, and they have different attitudes. I mean, it's interesting just looking at the basic business morality of countries. Pretty much like, if you are cautious because you're sitting in Chicago doing investment, then you're probably going to lose out putting your money in. Because the Koreans just say, I don't really mind, I've got enough money, here's 10.
So, Mark, you raise a good point there, because I spoke to a security expert who is in a pretty famous company, and he told me this figure. He said somewhere, and this is, he won't publish this, but somewhere between 15 to 17.5% of every successful ICO is funded with either stolen or tumbled ransomware tokens, or stolen in some way, illicitly gained. So that means we know that, right? Well, it's not published, so we don't officially know it. But it's kind of obvious when you think about it, because you hear of all those being stolen, you see of all the ransomware, you understand tumbling and transforming is taking place. It's quite hard to track. And of course, it's possible that those ICOs, especially those where it was done pre the KYC rigor that's coming in now, they were funded with stolen illegal money. Now, that's going to bite us in the ass later, isn't it?
Volkswagen, one of the world's best and finest companies, is clearly the most corrupt company there's ever been. They were fined $21 billion for cheating, basically a $250 diesel part. The real world is much more corrupt than the crypto world. It washes it in different ways. But the thing is that right now, as long as you are legal when it comes in and you have done the best possible thing, the crypto world should not need to be better than everybody else.
I guess it would be we love this industry. Reputationally, we want to protect it. So are there things that founders can do these days over and above the KYC and AML? If you're a fund, you have to do beneficial ownership and real source of funds, right? Is there something we can do around that in crypto?
I mean, I think some of this is eventually going to be digitized. So, there are different teams working on, okay, how do we create a digital identity for people that clearly kind of transcends different protocols and different, it can perhaps be tied to net worth and handle accredited investor verifications and things like that. So yeah, there are a number of teams kind of working on solutions for identity that are comprehensive. I think the challenge is obviously they're all going to be kind of competing with one another, and if it's not something that is mandated by a government, getting majority adoption is going to be a challenge.
I mean, we love RegTech, and we love things that have regulatory drivers behind them.
Super sexy.
Yeah, you see, you heard that here first. Andrew, I want to talk about the people side of it, because the thing that I loved in particular, you mentioned the Founders Club. The thing I loved about that was it was risk mitigation. You mentioned you had this way
of liquidity as well,
and liquidity.
I've been pushing for liquidity my whole life.
So, but the risk mitigation, because you created collaboration way beyond normal by allowing founders to swap. I cared about your company. We'd meet and chat, and so you'd convene that. So is there a mechanism around that type of risk reduction which would encourage, instead of competitiveness, collaboration? And do you think you might introduce some of that in 7BC?
Well, so I did this Founders Club where the founders would swap equity, and then I would pay out the 80% to them and 20% to me, and so it was like a fight club. Interestingly, there's a lot of these token generation, ICOs are swapping tokens with each other, so they've naturally created a Founders Club on their own, but. As you know, it's a tough thing. It's a tough thing, the Founders Club, and I learned that the hard way. Too many companies, they all call me on the weekends. It became really tough. But to answer your question of how to lower the risk, I would say, one, get legal up and understand the law and make sure you're not violating securities law in any jurisdiction. That can be done. So do legally compliant, securities deals, and then old school diversification. If you're an investor, investing into a single startup is very risky. If you diversify across 25, it's less risky. And do old school due diligence. That's venture capital due diligence of, spend time in person with the team and identify companies that are leveraging this incredible technology of DLT and smart contracts and tokenization and building communities and going beyond 5 white guys from Boston that moved to Palo Alto and get a bit more international, which is important, and invest in companies that are going to be high growth, profitable companies that on a discounted cash flow basis will be really great acquisitions for Google and Twitter and Facebook and IBM and everybody else. So
we look forward to that.
We're investing in real companies, not like a child in Florida with a credit card doing pump and dump with no DD.
So Eric, I'd actually like to introduce another risk that I think it's important to touch on, and most people wouldn't address. Is just the risk because of the price volatility and everything of getting scared off and not investing and not getting involved in the space.
Risk, yes.
And I think it is very real. And so I've spent and I'm constantly thinking about the right way to frame this and the right perspective to give people. But having been involved in the space for a long time, as a number of us have, I have dozens, if not hundreds of people on a monthly basis coming to me and asking me how to get exposed in the space. And, I try to help them, whether it's getting involved as an entrepreneur or how to invest in the space. And so, the way what I've been telling people is, let's say, take whatever X percentage of their capital that they're putting in, put a little bit into direct holdings, whether choosing a couple of the top digital assets, putting it into one of the index funds that are out there, put a little bit into long-term tied-up capital into a VC fund in the space where they're not going to get shaken out by the volatility, and their capital is committed, and they'll catch a lot of the growth over the medium and long term. And then put a little bit, if they want to be aggressive, into ICOs, or if they want to be a little bit more conservative, into some alpha-generating strategy, something doing arbitrage, right? And so anybody who's done that has
exchange arbitrage? Can you still do that?
Exchange arbitrage or just other
It's
strategies.
amazing that, right? That's free money if you know what you're doing.
Eric, can I jump in on this? I mean, the funny thing is that crypto is like a movement, right? So the rational thing to do when you've raised $30 million of Ether in your ERC20 token offering is to put it all into fiat. That would be the rational thing to do. But after you've come home from Korea and Singapore, you're not thinking rationally. And so
I think rational. I mean,
I wouldn't hold that
rational
against
is
Korea
very
and
much,
Singapore. It's other reasons.
No, I'm just saying, these people, they travel the world, they raise their money, and they're like, holy shit, Ether is everyone needs it. But, they should put it all into fiat, but they don't want to. So what percentage do you keep in crypto? And it raises the treasury management, Arianna, that you brought up. And so we're suggesting to these companies, look, let's sit down with you and say, what's your operational expenses? How much money per month should you be spending? Let's keep some of it in crypto, but let's do treasury management, diversify, and even use our ability to get into new listings that we know are oversubscribed. And what's interesting is that these companies are raising more money than they really need. It's beyond the normal milestone 18, 24-month runway. So they got more than 24 months. They can put some of this basically into your fund or my fund, and it can become a source of income, and it can increase the burn rate. And I even think it can avoid, for guys like me that have been around, we know people that have killed themselves. It can avoid suicide and disaster and marriages and all kinds of problems. And it's a great thing for entrepreneurs to be able to raise more than you need, get some treasury management, and keep funding yourself while you pivot.
We're a little bit low on time. Mark, I know that you have a lot to contribute, but also there's stuff that I want to ask you about, which is a little bit left, but it's about risk. I was going to put it under the heading of regulatory risk, but no, I'm going to put it under Trump risk and Brexit risk. So I know that you care about this topic. Can I ask you to stick your neck out? What are the odds at the moment, from your perspective, and you know how you love the data, of no Trump, no Brexit?
So I make predictions about what's going to happen. So I got Trump right. I gave him an 85% chance of winning as soon as he nominated himself. Got the reasons out. I got Brexit right. I got Macron right within 1 percentage point. I mean, there's a number of things. I have a 25-year plan to change the world, but it's definitely a drinks conversation, not here. So I see things, and I'm looking out and I'm tracking things. Right now, if I give you my Brexit stuff, I've got no Brexit at 60%, and I think it explodes in November. And there's a bunch of reasons why.
Oh, wow,
and on
okay.
Trump, I've got Trump at 50% that he will not survive his third year.
I know it's not very relevant for
You're
this.
saying UK is not going to leave the European Union?
Yeah, awesome.
That's good for my UK passport.
Please put your hands together.